This is an important table. This is gold's annual rate of change against 9 of the world's major currencies: the US dollar, Australian dollar, Canadian dollar, Chinese yuan, euro, Indian rupee, Japanese yen, Swiss franc, and the British pound. Now, I'd like to make a couple of important observations about this table. First of all, if you look across the bottom, the annual average rates of appreciation, gold is without a doubt one of this decade's best performing asset classes. But very few people are paying attention, notwithstanding these tremendous results. It's up 8 years in a row against the US dollar. We still have 2 months to go this year, but it looks like it's going to be up nine years in a row against the US dollar. There are very few red marks on this table. Very few years when gold has actually lost value relative to currencies. So you can see we've had double-digit rates of appreciation against all of the world's currencies. This is the annual average rate of appreciation. This is a very simple way to, preserve your liquidity, preserve your purchasing power. Just hold gold. And we're in a bull market, and these rates of appreciation, in my view, are going to continue going forward. We're seeing it this year. We're going to see it next year as well. There's another point that I would like to make about this table. If you look at 2008, you can see in the bottom that gold was down 14.9% against the yen in that year, and it was up 44% against the British pound in that same year. Now, people look at that and they say, well, gold is a volatile commodity. But my point is you can't really look at any one year, any one month, or group of months. You have to look at gold over the long term to determine whether or not gold is really volatile. And you can see that notwithstanding those disparate rates of appreciation last year between the yen and the British pound, their annual average over this 8-year period of time is 13.6% for the yen and 17.1% for the British pound. So the volatility does not come from gold. Gold is not a volatile commodity. In a world of floating currencies that bob up and down relative to each other, it's these floating currencies that create the volatility, not gold. If gold were volatile, you wouldn't see double-digit annual rates of appreciation against all of these currencies. The volatility comes from central banks changing one policy in one country, affecting the currency, it goes up or down, and this is where the volatility comes from. So gold is not a volatile commodity. And in order to appreciate this, we have to start calculating the price of goods and services in terms of gold to truly understand what's happening. And I'll do that in a minute, but I'd like to make one more point about this particular table. This table compares gold to what it should be compared against. In other words, it's comparing gold against other forms of money. This is an important thing. There's an old Chinese saying that says that wisdom begins by calling things by their right name. And if you call gold an investment, you're starting down the wrong road. Gold is not an investment. Gold is money.